Your portfolio has a 99% chance of failure, okay? Is that a literal scientific statistic? No. But is it a structural certainty that your portfolio is set up to fail you in the next major crisis? Absolutely. This isn't about your investments going to zero. It's about the near certainty that your portfolio will fail to protect you when the economic dominoes start to fall. For decades, we've all been told the same thing. Diversify. Buy some stocks, add some bonds, and you're good to go. But that entire strategy is built on a fatal flaw. A flaw that was brutally exposed in 2022 when those supposedly safe diversified portfolios crashed right alongside the stock market. In this video, I'm going to show you that flaw. But more importantly, I'm going to walk you through the simple structural changes you need to make to build a portfolio that is genuinely resilient. One designed not just to survive a crash, but to weather any economic storm. Section 1. The fatal flaw in your portfolio. So, to see the problem, you have to understand the big lie of diversification. When your financial advisor tells you to diversify, what they really mean is to buy a bunch of different stocks and maybe mix in some bonds. This protects you from one specific kind of risk called idiosyncratic risk. That's just a fancy term for one specific thing going wrong. You know, a company you own has a scandal or its new product is a total flop. If you own 50 different stocks and one of them goes bust, your portfolio takes a small hit, but it survives. That's diversification, and for that one job, it works. But there's a much bigger, nastier monster out there called systematic risk. This is the risk of the entire system going down. Think of the 2008 financial crisis or the 2020 pandemic crash. In those moments, it doesn't matter if you own tech stocks, industrial stocks, or boring blue chips. When the whole market panics, everything falls together. For years, the answer to this was the classic 60-40 portfolio, 60% stocks, 40% bonds. The theory was simple. When stocks crash, people flee to the safety of bonds, which pushes bond prices up and cushions the blow from your stocks. And for a long time, it worked beautifully. And then 2022 happened. In 2022, facing the worst inflation in 40 years, central banks jacked up interest rates at a historic pace. This created a perfect storm. Stocks tanked because everyone feared a recession, but bonds, which get crushed by interest rate hikes, also tanked. The 60-40 portfolio, the so-called gold standard of safe investing, got hammered, posting its worst performance in decades with losses around 16 to 17%. Both the engine and the brakes failed at the same time. And that right there is the fatal flaw in almost every portfolio. They aren't truly diversified. They are all just different flavors of the same bet. A bet on one specific future where economic growth keeps humming along with low inflation. When that bet goes wrong, the whole house of cards comes down. The answer isn't to ditch stocks or bonds. It's to build a portfolio that's structurally balanced to handle different economic seasons. It's what sophisticated investors like Ray Dalio, founder of the world's largest hedge fund, have preached for years with his all-weather philosophy. The goal is to be ready for anything, not just hope for the best. So let's rebuild your portfolio with 3 crucial changes. Section 2. Change 1. The true safe haven. First things first, we need to completely reevaluate your portfolio's defensive core. 2022 proved that the 40% of your portfolio that was supposed to be your shield could actually become another anchor pulling you down. The fix is to be much more specific and incorporate long-duration U.S. Treasury bonds. Now, I know what you're thinking. Bonds, the asset that just got obliterated. Are you crazy? Hear me out. While almost all bonds got hammered in the inflationary storm of 2022, long-duration treasuries play a uniquely powerful role during the other kinds of crises, the ones driven by recession, panic, and deflation. Take the 2008 financial crisis. As the S&P 500 was in complete freefall, the long-duration treasury ETF, ticker TLT, delivered a staggering 28% return. Or think about the COVID crash in early 2020. As stocks plunged, TLT jumped about 18% while investors ran for cover. This flight to safety is a powerful reflex in the market. When real panic hits, investors don't just buy any bonds. They scramble for the safest asset on planet Earth, the long-term debt of the US government. This surge in demand drives their prices sky high, providing a powerful airbag against your falling stock prices. Yes, the losses in these bonds since 2020 have been historic, but that was driven by a very specific enemy: inflation. In the more common panic-driven crashes, they have proven to be the most reliable defender a portfolio can have. By allocating a piece of your portfolio to an ETF like TLT, you're not just holding bonds, you're holding a specific tool designed to zig when everything else zags. It's the true safe haven. Section 3. Change to the inflation-proofing layer. Our second change deals with the very monster that broke the 60/40ths in the first place: inflation. When prices are spiraling upwards, cash is trash, and both stocks and bonds can get steamrolled. The solution is to add a dedicated layer of real assets. These are tangible things that have intrinsic value and tend to hold on to that value, or even rise when paper money is losing its own. We're not talking about just one thing, but a basket. The two most important and accessible for most of us are gold and a broad basket of commodities. First, gold. For thousands of years, gold has been the ultimate asset to own when confidence in governments and their money starts to fade. During the stagflation of the 1970s, stocks went nowhere for a decade while gold's value exploded. And from 2007 to 2009, during the Great Recession, gold posted impressive gains. An easy way to own it is through an ETF like GLD. Second, a broad basket of commodities. This is stuff like oil, natural gas, farm goods, and metals. The logic here is incredibly simple. What is inflation? At its core, it's the price of raw materials going up. So why not just own the raw materials? By owning a diversified commodity fund, like the DBC ETF, you own an asset that's structurally set up to benefit from the very force that's hurting your stocks and bonds. This is exactly what we saw in 2022, when commodity funds were one of the few bright spots in a sea of red. By adding this layer of real assets, you're building a foundation that doesn't crack under inflationary heat. You're preparing your portfolio for a completely different kind of storm. Section 4. Change 3. The all-weather engine. This final structural change is the one that truly separates a fragile portfolio from a resilient one. Right now, your portfolio likely has a huge weakness. It really only makes money when asset prices go up. To fix this, we need to add an engine that's designed to perform in any environment, up or down. The strategy is known as managed futures or trend following. For years, this was a secret weapon reserved for high-end hedge funds. But today, it's available to anyone through Here's an easy way to think about it. Imagine your portfolio had a navigator that could automatically sense the direction of a market S-trend. When stocks are in a strong bull market, it goes long with them. But when a market crashes and enters a painful bear market, the system automatically starts shorting, betting on prices to fall. Now imagine that system is doing this across dozens of markets all at once: stocks, bonds, currencies, and commodities. That's exactly what a managed futures strategy does. It's designed to be uncorrelated to both stocks and bonds, making it a diversification powerhouse. Its power was on full display in both 2008 and 2022. During the 2008 meltdown, these strategies posted huge positive returns while everything else burned. And in 2022, when both stocks and bonds were plummeting, managed futures were again one of the only strategies that delivered big gains. They did it by correctly riding the big trends of the year: a soaring US dollar, falling bonds, and rising commodities. Now, this strategy isn't magic. In boring sideways markets, it can lag, but its job isn't to beat the market in a bull run. Its job is to generate crisis alpha, to make money during sustained periods of chaos when nothing else is working. Adding a managed futures ETF like DBMF or KMLM gives your portfolio a truly independent source of returns. It gives it the ability to profit from chaos, not just be a victim of it. So let's zoom out. The fatal flaw in most portfolios isn't the stocks you pick. It's a flimsy structure built on a single bet that the future will look like the past. As 2022 proved, that bet can go horribly wrong. But by making these 3 structural changes, you can transform your portfolio from something brittle into something truly robust. First, you balance your stock risk not with just any bonds, but with a true safe haven, long-duration treasury bonds, which shine in deflationary panics. Second, you build a firewall against rising prices with real assets like gold and commodities, protecting you when your paper assets are losing value. And third, you install an all-weather engine with managed futures, giving your portfolio the rare ability to profit from major trends, whether they go up or down. This isn't about timing the market or finding the next 10-bagger stock. It's about building a smarter structure. It's about owning a portfolio that is prepared for any economic season. You might trade some of the wild upside of a raging bull market for something far more valuable: the peace of mind that comes from knowing you are ready for whatever comes next. If you found this framework valuable and want to see exactly how to put it into practice, make sure you subscribe and hit the bell. In our very next video, we're going to dissect how rich people use debt to build wealth, and how you can also do the same. If you'd like to see more videos like this, do me a favor and hit the like button and subscribe for more content that challenges traditional financial advice.